Understand tension. Imagine you lent your neighbor $20. You'd expect to get $20 back. Simple. Now imagine you lent him $20 you didn't actually have, that you created the $20 by writing down a number on a piece of paper, handing it to him, and then legally charging him interest on it. You'd probably be arrested. Banks do this every single day, and it's not a conspiracy theory. It's just how banking works. Right now, in 2026, global debt sits at roughly $300 trillion. That's 300 trillion, a number so large it stops meaning anything. And yet economists aren't panicking about where all that money came from, because they know something most people don't. Most of that money was created by commercial banks, not governments, not central banks, regular banks, the one on your high street, the app on your phone. Understanding how that works doesn't just satisfy intellectual curiosity. It changes how you think about interest rates, inflation, mortgages, crashes, and bailouts. It reframes almost everything about the modern economy. So let's actually explain it. You were probably taught that banks take deposits, keep a little in reserve, and lend out the rest. Your money goes in, someone else borrows it, the bank earns a margin. Clean, logical. That model is wrong, or at least profoundly incomplete. Here's what actually happens. You walk into a bank and apply for a mortgage, say $200,000. The bank doesn't go into a vault, find $200,000 in someone else's savings, and hand it to you. No one's savings are touched. Instead, the bank opens a spreadsheet, metaphorically, and types in a number. $200,000 appears in your account. It did not exist before that moment. The bank created it by making an accounting entry, an asset on one side of their ledger, a liability on the other. Balanced, clean, legal. The Bank of England confirmed this in a 2014 paper. The reality of how money is created today differs from the description found in some economics textbooks. Banks create new money whenever they make loans. Not a fringe claim. The central bank of one of the world's oldest financial systems said it plainly. And now you owe the bank $200,000 plus interest for money that cost them almost nothing to produce. Here's the part that quietly unravels things. The bank created the principal, $200,000, out of nothing, but it did not create the interest. So where does the interest money come from? Someone else has to take out a loan to generate it. The system requires a constant expansion of debt just to service existing debt. It doesn't work in reverse. It only works if it keeps growing. That's not a design flaw someone overlooked. That's the architecture. This is why central banks have inflation targets instead of zero inflation targets. A growing money supply requires growing prices. Deflation, money becoming more valuable, is catastrophic in this system because it makes debt impossible to service. It's also why 2008 was so severe. When banks stopped lending, money stopped being created. The supply contracted, credit froze. Not because anyone stole anything, just because the accounting entries slowed down. The bailouts that followed weren't governments rescuing irresponsible gamblers out of kindness. They were patching the machine that creates the money that runs everything. The machine couldn't be allowed to stop. And so the institutions that had the power to create money were also deemed too important to fail, which gives you some sense of where actual power sits in this system. No resolution. Leave it hanging. Final line should stall in the viewer's head. None of this is hidden, exactly. The Bank of England publishes it. Economics departments teach adjacent versions of it. The mechanisms are documented. But there's a gap between information being available and it being understood. And that gap is, perhaps, quite convenient for some people. So the question isn't really whether banks create money out of nothing. They do. The question is what it means that a private institution has that power. Who decides how much new money enters the world, and who benefits first when it does? whoever controls the money supply controls quite a lot more than money.